What if I told you the scariest part of a market crash isn't the crash itself? It's what happens before. It's the feeling that everything's fine. The headlines are optimistic. Stocks are up. Your neighbor just made 40% in a month. The experts on TV say we're entering a new era. And then it all disappears. In April 2025, $5 trillion vanished from global markets in 1 week. A single Liberation Day policy change triggered panic. A concerning pattern signaling 1994, when a sudden shift in interest rates blindsided investors and crushed markets. But most people, they didn't see it coming. They never do. Because before every crash, no matter how different the details are, the same patterns always show up. Subtle, repeated, ignored, until it's too late. So today, we're going back in time. 5 crashes, 5 centuries, 5 clear signals that always show up before the fall, and what they're telling us about what might be coming next. To understand what's coming next, we have to go back, way back. Because while every crash looks different on the surface, the psychology behind them hasn't changed in 500 years. This isn't about predicting the next headline. It's about spotting the warning signs that are always there, if you know where to look. We'll break down 5 crashes from 5 centuries, some famous, some forgotten, but each shows one of 5 repeating patterns. And when we finally reach today's market, you'll see why Warren Buffett is nervous, why Trump's policies rattled investors, and why the next crash may have already started. But first, to understand how crashes form, we need to rewind the clock. Way back, before Wall Street, before the Fed, even before the steam engine, to a time when the richest country on earth wasn't the US, but the Netherlands. A booming economy, a flood of new money, and a flower so rare, it sparked the world's first financial frenzy. Because if you want to understand market psychology, you start with a tulip. In the 1600s, the Netherlands was exploding with wealth. They had just thrown off Spanish rule, launched the Dutch East India Company, and built the world's first formal stock exchange. They were young, powerful, and dominating global trade, kind of like the US after World War II. And like any nation that suddenly finds itself rich, they developed a taste for status. Specifically, tulips. Yes, flowers. Tulips became a luxury good. Rare colors were seen as symbols of wealth. People would commission oil paintings of themselves holding tulips, like it was a Rolex or a Lambo. At first, it was just rich people flexing. A single bulb, just the underground part that grows into the flower, might cost a month's salary. But it escalated. Soon, people were spending a full year's wages on tulips, then 2 years, then 5. Why? Because people weren't just buying flowers. They were buying the idea that someone else would pay even more tomorrow. And that's when the Dutch invented something new. Futures contracts, agreements to buy tulips at a set price later. At first, it was smart. You could lock in a good price now and pick up your flowers next season. But then, prices kept rising. Suddenly, the contracts themselves became valuable. Forget the flowers. People started flipping the contracts. Speculators who never even saw a tulip were making fortunes on paper. A contract that said you get 10 tulips in spring could sell for the price of a house. At its peak, one tulip variety was worth more than 5 years' income. That's like paying $250,000 for a single flower today. People traded land for bulbs. Some borrowed money to buy more. There were even tulip investment syndicates, groups pooling capital to get in on the action. It was no longer a flower market. It was a fever dream. Everyone assumed the boom would continue. Even if prices dipped, people told themselves they could just grow more. Besides, tulips were beautiful. They were different. Until suddenly, they weren't. One failed auction, one nervous buyer, one panicked sell-off, and the bubble popped. Overnight, tulip prices collapsed. Contracts became worthless. Land that was planted with high-end tulips lost its value. The economy shrank. Investors were ruined. The fallout wasn't just financial. Friendships broke apart. Merchants who had bet everything lost their homes. Courts were clogged with lawsuits over tulip contracts. And the worst part? No one thought it could happen. Confidence had become culture. A satirical pamphlet from the time joked, "Many a plowman has high hopes when he sows his grain, and all he reaps is stubble." The Dutch weren't dumb. They were just human. This was the world's first documented financial crash, and the first timeless signal was already here. Overconfidence. When people start believing it's different this time, that the boom is justified, that this asset is special, the seeds of collapse are already planted. Today, it's tulips. Tomorrow, it's stocks with no earnings, digital coins named after dogs, or real estate priced like gold bars. But overconfidence? That's always in season. And just like in 1637, we'll ignore it until the next big boom turns to silence. But the next time we did it, we didn't even wait for the flowers to bloom. We built the entire economy around hope, and it came crashing down in steel and smoke. By the 1870s, America was booming. The Civil War was over. Industry was exploding. Railroads were stretching coast to coast. Steel, coal, telegraphs. The U.S. was modernizing by the mile. At the center of it all was a banker named Jay Cooke, the man who helped finance the Union's war effort. He was a legend on Wall Street, and now he had a new mission: build the Northern Pacific Railway. But laying track across the American frontier wasn't cheap. Cooke needed a massive investment, so he did what any ambitious financier would do. He started selling bonds. At first, investors were excited. Railroads were the future. Cities were sprouting up around every new line. And the bonds? They seemed like a guaranteed path to wealth. But here's the thing about booms. They don't end with a crash. They end with a pause, just long enough for people to load up on risk. Cooke wasn't just selling promises. He was stacking leverage. He sold more bonds than there was real demand for. The bank's balance sheets were bloated with assets that only had value if everything went perfectly. And for a while, it did. Profits rose, land values surged, investors felt like geniuses. But underneath it all, cracks were forming. Freight demand was slowing, construction costs were climbing, and then one thing broke: trust. In 1873, Cooke tried to issue another round of Northern Pacific bonds, but this time, the buyers didn't show up. There were talks about overreach, about bad loans, about risk. Within days, Jay Cooke and Company's collapsed, and just like that, the entire system seized up. Banks started calling in loans. Depositors rushed to pull their cash. Companies that had nothing to do with railroads started failing because the credit lines dried up. The New York Stock Exchange shut down for 10 straight days, the longest closure in history. The panic jumped oceans. London, Berlin, Vienna, they all felt it. This was the start of the Long Depression, a downturn so deep that it reshaped the labor market, collapsed entire industries, and left Europe limping for decades. Factories closed, wages collapsed, farmland was abandoned, and railroads, once the symbol of progress, were sold for scrap. But this wasn't about bad luck. It was about leverage that no one could see. Investors thought they were funding growth, but they were really feeding a machine built on assumptions. Assumptions that growth would always continue, that debt would always be rolled over, that someone would always buy the next bond. And when the engine stopped, the leverage snapped. This wasn't a case of people losing their minds. This was greed, backroom deals, overpromised returns, safe assets that weren't safe at all. And this was pattern 2, hidden leverage plus economic overreach. It doesn't matter how strong the economy looks from the outside. If the foundation is built on borrowed money, confidence, and hope, all it takes is a single shock to bring it down. And here's the scary part. Back then, the danger was hidden in balance sheets no one read. Today, we've seen this movie again. Shadow banking, private credit markets, leveraged loans are hidden from view. When the music's playing, nobody asks about the speakers. But the second the tune stops, everything built on that rhythm falls apart. The 1873 crash wasn't driven by panic. Panic was just the final domino. It was built on silence. And silence is what always comes before the crack. And next time, we didn't just bet on steel rails, we bet on paper and pride. The collapse that created the Great Depression. The 1920s were roaring, and Wall Street was the party. Factories were running. Radios and refrigerators were changing homes. Cars were rolling off assembly lines by the millions. And stocks? They only went one direction, up. New York was the financial capital of the world. Bankers became celebrities. The average investor didn't just trust the market, they believed in it. The common wisdom? Stocks will make you rich, and if you want to get rich faster, borrow. That's what made this boom different. Margin loans. You could borrow 90% of the value of a stock just to buy more stock. It wasn't just professionals. Everyday people were taking out loans, betting on the market with money they didn't have. Kids mailed $4 checks to investment firms, trying to buy into the dream. Even shoe shiners were handing out hot stock tips. And the firms? They weren't worried. In fact, they created new investment vehicles, like leveraged trusts, to help people pile in even more. These trusts would borrow money on top of investor money to buy even more stock. It was stocks on debt. And here's the scary part. Regulators didn't step in. Not really. The Federal Reserve watched. Congress watched. The press cheered. Everyone was making money. No one wanted to be the one to spoil the party. President Calvin Coolidge famously said, "The chief business of the American people is business." So, the blind spot wasn't just financial. It was cultural. And the boom kept going. Until it didn't. On October 24th, 1929, Black Thursday, the market opened with chaos. Panic selling, phones ringing off the hook, brokers screaming over each other. A few days later came Black Tuesday and the bottom fell out. Over the next 3 years, the stock market would lose 89% of its value. Banks failed. Businesses closed. 1 in 4 Americans lost their jobs. Families lost homes. Breadlines formed. The Great Depression had begun. And all of it was made worse by the same toxic mix. Credit without guardrails. Leverage layered on leverage. No one brave enough to hit pause. This wasn't just a financial failure. It was a crisis of trust. Millions of Americans never invested again. Some never recovered. This crash finally forced reform, including the Glass-Steagall Act, separating commercial and investment banking, and the creation of the FDIC to protect depositors. But by then, the damage was historic. And the lesson? It came too late for millions. And this is pattern 3, regulatory blindness plus credit explosion. When a market rises too fast for the rules to keep up, people always say the same thing. This time, it's different. They said it in 1929. They said it in 2007. And we're hearing it again. Today's markets are flooded with innovation, AI-driven trades, complex ETFs, unregulated crypto platforms, private tokenized securities, meme stocks with no earnings. The speed has changed, but the oversight hasn't. And credit? It's just wearing better clothes. Buy now, pay later apps, trading apps that let you margin with a tap, derivatives inside pension funds and 401ks. The risk hasn't disappeared. It's just been rebranded. The 1929 crash wasn't caused by one bad bet. It was the slow buildup of fragile optimism, built on borrowed dollars and blind trust. We didn't see the crash coming because we didn't want to. And the next time, we won't just ignore the warning signs. We'll live stream them. The day Asia's economic miracle fell apart. In the mid-1990s, Southeast Asia looked unstoppable. Thailand, Indonesia, Malaysia, South Korea. These were the Asian tigers. Their economies were booming. Foreign investors were pouring in money. New skyscrapers, highways, and airports rose like dominoes. And why not? Growth was through the roof. Currencies were stable. Western firms couldn't invest fast enough. Magazine covers called it the Asian miracle. GDPs were rising in double digits. The middle class was growing. It felt like this was Asia's century. But under the surface, something fragile was building. These countries had one thing in common. They were borrowing heavily in US dollars. It made sense at first. Borrowing in dollars meant lower interest rates, more capital, faster expansion. And the returns? Huge, as long as the local currency stayed strong. But there was a catch. The revenue, the money to pay those loans back, was in local currency. And that meant if the value of their currency dropped even a little, the cost of their debt would skyrocket. It was a currency mismatch time bomb. In 1997, currency traders started betting against the Thai baht. They believed the Thai government couldn't maintain its peg to the US dollar. They were right. Thailand's central bank burned through its reserves trying to defend the currency and then gave up. The baht collapsed. And so did confidence. In just days, investors began pulling money out of neighboring countries. Panic spread from Thailand to Indonesia to South Korea. One economy after another went from miracle to meltdown. It wasn't just the currency. It was the momentum. The herd had turned. Investors who once fought to get in were now rushing to get out. Stock markets crashed. Interest rates spiked. Companies defaulted. Governments begged the IMF for emergency loans. And the human cost was brutal. Unemployment, poverty, protests, riots. The entire middle classes were wiped out almost overnight. All because of a simple assumption: the capital would always be there. That brings us to pattern 4, the danger of herd behavior and foreign capital fragility. When everyone's chasing the same story, the hot economy, the rising star, the can't-lose market, it feels safe. Until something breaks and the exits get crowded. This wasn't a classic debt bubble or stock mania. It was a confidence bubble, and confidence evaporates faster than capital. We've seen versions of this again and again. Argentina, Turkey, Sri Lanka, markets with hot growth but fragile currency foundations. Today, it's countries dependent on dollar inflows, corporations with USD debt they can't print, sovereigns locked into carry trades they don't control. And as always, when the tide turns, it turns fast. The 1997 started in a currency and ended in a continent-wide collapse. And next time, it won't be just Southeast Asia. It could be anywhere. Because if the 1990s showed us how fast fear can spread, the 2000s showed us how fast hope can too. In the early 2000s, China wasn't just rising, it was exploding onto the world stage. The country had joined the World Trade Organization. Factories were humming. Exports were booming. Cities like Shenzhen and Shanghai were turning into modern marvels almost overnight. And the people believed in the Chinese dream. For the first time, millions had savings. Millions more were moving into the middle class. And in 2006, they began pouring into something that felt new and thrilling, the stock market. See, in the West, people grow up with 401ks, mutual funds, CNBC. In China, for decades, investing was a foreign concept. Stocks were either too risky or too mysterious. But that changed fast. The government's state media began promoting financial literacy. There were shows and ads encouraging citizens to invest in national champions, big state-backed companies like PetroChina or ICBC. And they listened. By mid-2007, more than 300,000 new brokerage accounts were opening every single day. Street vendors, retirees, college students, even farmers, all of them were buying stocks, most of them for the first time. In Beijing, subway stations began posting live stock tickers. TV anchors talked about the new China and how anyone could be part of it. The Shanghai Composite shot up 130% in 1 year. It was pure euphoria. Some stocks rose 10 times based on little more than state rumors. At the height of the frenzy, people weren't buying stocks based on earnings or business plans. Some investors chose companies just because the ticker symbol had lucky numbers. Others jumped in simply because their neighbors were making money. It didn't matter what the company did as long as the price was going up. That's how detached things became. Fundamentals were forgotten. Hype took over. But here's the twist. The market was state-supported until it wasn't. The Chinese government, nervous about inflation and instability, suddenly raised interest rates and increased trading fees. And then it issued warnings about stock speculation. It was like yanking the steering wheel in a speeding car. In October 2007, the bubble burst. Within months, the Shanghai Composite lost over 70% of its value. Life savings vanished. Grandparents who'd never touched a stock before the year prior were now staring at blank screens, shocked. And it didn't just hurt China. The collapse contributed to global risk-off sentiment, especially as Wall Street's own subprime crisis was unfolding. What went wrong? China's stock bubble wasn't just about greed. It was about trust. In the state, in the system, in the dream of a shared future. People thought the market couldn't fail because the government wouldn't let it fail. And that brings us to Pattern 5, a modern twist on investor overconfidence. State-fueled speculation paired with financial repression. When everyday savers have nowhere else to put their money, and the government starts dropping hints of guarantees and gains, the bubble can grow faster than reason and pop harder than anyone's prepared for. And what's the legacy? To this day, many people in China's middle class still avoid stocks. They'd rather put their money in real estate or gold. The memory of that crash stuck, and the trust never fully came back. And the big lesson? When markets rise on stories, not profits, they can grow fast, but they can also fall just as fast. Because if all it takes is belief to keep things going, then all it takes is doubt to bring it all down. So now that we've seen these 5 patterns through history, what about today? Are they repeating? And if you've been listening closely, you'll notice the same 5 patterns that showed up before every major crash we've explored are showing up again, right now, just in different clothes. First, speculative overconfidence. We saw this in the 1600s with tulips being flipped for fortunes. Again in 1873 with railroad shares hyped far beyond their real value. Then in 1929 when shoe shiners were handing out stock tips. In 1997 when the Thai baht was invincible. And in 2007 when every Chinese factory worker had a stock portfolio. Today, a lot of people are investing just because prices are going up. You see it in AI stocks, in meme coins, and even in things like collectibles. People buying shoes, trading cards, or old cars, thinking they'll sell them for more later. They're not asking what it's worth. They're just hoping someone else will pay more. That's the same kind of thinking we saw with tulips, railroads, and housing before every crash. It feels safe, but it's not. Second, new, poorly understood innovations. The tulip bubble had the futures market. The 80s had portfolio insurance. The 2000s had complex mortgage-backed securities that no one fully grasped. Now, it's algorithmic investing, AI-powered trades, and tokenized assets. We've taken complexity to a new level and handed it to retail investors with zero training. Finance is becoming faster, fashionable, and harder to understand. That's a problem, because we've seen what happens when markets are filled with products no one knows how to price until they break. Third, debt-fueled growth. From land speculation in the 1800s to over-leveraged banks in 1929 to shadow finance in 1997 and 2007, debt was always the accelerant. It made the highs higher and the crashes harder. Today, household credit card debt is at an all-time high. Corporate leverage is rising, especially in sectors like commercial real estate and tech. Buy now, pay later isn't just for shoes, it's for groceries. And when the Fed raised rates, the borrowing didn't stop. It just got riskier. Global debt now sits above $315 trillion. The difference now, the entire world is overleveraged, and that never ends well. Every major crash had them. The tulip bubble had no financial oversight. In 1873, governments were too slow to respond. In 1929, rules didn't exist for leveraged investment trusts. In 1997, Asian markets lacked safeguards. And in 2007, Chinese regulators pumped the market, then pulled back too late. Today, crypto remains a gray zone. AI in finance has no clear regulation. Private lending is exploding off balance sheet. And this is where Trump's angle comes in. Under his last administration, key banking safeguards, including parts of Dodd-Frank, were rolled back. Regional banks took on more risk. Now, his campaign is signaling even deeper deregulation. That might sound bullish for business until it breaks. Fifth, fragile capital flows and herd behavior. When money rushes in too fast or pulls out all at once, it bends markets until it breaks. This was the case in 1997 when foreign capital flooded Southeast Asia, then disappeared overnight. It was true in China in 2007, when local hype pulled in unsophisticated investors who got burned in a wave of panic selling. Now, billions are rushing into Indian tech, US AI, even Trump-themed meme stocks, but emerging markets are drowning in dollar-denominated debt. China's economy is wobbling, and global investors, they're crowding into a few hot trades with very tight exits. As Buffett famously said, you don't find out who's swimming naked until the tide goes out. So what do you do when history screams the same warnings over and over? You listen, you prepare, and you resist the urge to panic. Because here's the truth. Market crashes aren't random. They're not black swan events falling from the sky. They're built slowly, pattern by pattern, until something breaks. Let's bring it back to the 5 patterns. Each one: speculation, confusing innovation, runaway debt, regulatory blind spots, fragile herd dynamics. They didn't just destroy value. They tested belief. They shook the idea that the future was predictable, but they also created opportunities for people who understood the signals. So here's what smart investors do now. First, stay grounded. If you're chasing 10 times returns, flipping meme stocks, or piling into the latest AI startup because it's the next big thing, take a breath. Investing isn't a race, and easy money has a habit of disappearing fastest. Stick with what you understand. Ask what something is actually worth, not just what someone else will pay for it tomorrow. Second, stay liquid. That doesn't mean selling everything. It means having cash or safe reserves on the side. Dry powder. So, when the market does dip, you're ready to buy. Remember, crashes are clearance sales for people who've planned ahead. Third, look under the noise. Is that shiny new investment product actually safe? Does the platform you're using actually explain risk? Are the numbers too good to be true? If you can't explain what you're buying to a teenager in one sentence, maybe you don't understand it enough. Fourth, play the long game. Buffett made his fortune not by timing crashes, but by buying great businesses and holding them through the storm. If you're investing for 10, 20, or 30 years, short-term drops don't destroy wealth. Fear-based decisions do. Fifth, don't get seduced by headlines. Markets will swing based on Trump's tweets, Fed speculation, global drama. That noise, it's just that, noise. History has seen panics, wars, depressions, and still, over the long haul, markets recover. The goal isn't to predict every twist. It's to stay in the game long enough to benefit when it turns. So don't panic. Don't YOLO your savings into hype. And don't assume that because it's different this time, it actually is. Trump's adding trillions to the national debt. But could it be a planned market crash? Click the video on screen to find out.